perhaps maybe not in the next few weeks, but certainly in the next few months, quarters, or even years, I'm not convinced that this H2 2023 technical recession will stand the test of time.
And Sanjay, just to go back to something you were saying a moment ago, you were talking about the likely path for interest rates later this year. I mean, it feels very much as though the Federal Reserve is going to start cutting much later in the US than we thought likely. Is that not possibly going to be the case in the UK now that all the rate cuts that we get from the bank are going to be back half loaded?
Well, everything's possible, Ian, but I wouldn't be so sure about that. The UK economy is in a very different place to where the US economy is. The US economy is running at potential. We're just potentially coming out of a technical recession. We have an unemployment rate that's slowly edging up. The data is a little bit dodgy, but notwithstanding that, we're seeing signs of loosening in the labor market. Inflation, in about a month's time, we'll see headline CPI fall below 2%. So price pressures are easing, not just on the energy front, we're seeing it on the food front, core goods inflation, even services inflation, which has been very, very stubbornly resilient, that's starting to come off a little bit. So I think the key question for the Bank of England, which we'll get maybe an answer to next week, is how restrictive, is sufficiently restrictive, is 5.25, which is where the bank rate is at the moment. Is that what we need to see over the next few months to get inflation sustainably back to target? The US is in a little bit different story. It's a different pace. We're seeing different price pressures firm. Whereas in the UK, the story is a lot different. We are seeing a cooling labor market. We are seeing price pressures come off quite significantly, even at the headline front. And that, we think, should allow the Bank of England, even if it's a slow and gradual normalization, we should see bank rate come down slowly. 75 basis points of rate cuts is our expectation. 3/4 point hikes, we think, is very much manageable this year, and perhaps a lot more next year.
OK, Sanjay, we have to leave it there. Great to see you this morning. Thank you.
Thank you, Ian.
Some other business news stories for you now. Breaking news, and in the last hour, the insurer Direct Line has revealed it has received and rejected a second takeover approach from the Belgian multinational Ageas. Ageas, which 2 weeks ago offered £3.1 billion for Direct Line, said its latest approach valued the company now at £3.17 billion. But Direct Line said the board considered the latest proposal with its advisors and continues to believe it is uncertain, unattractive, and that it significantly undervalues Direct Line Group and its future prospects, while also being highly opportunistic in nature. I think I can show you the Direct Line share price right now. It's actually fallen 4.75% to £2.15 or so. The latest offer from Ageas came in at £2.37 a share, but a lot of that was in Ageas paper. Metro Bank said today it's planning more job cuts as it reported its first profit since 2018. The challenger bank, which announced plans last year to reduce its workforce by 1 in 5, now said it was expecting to do so by 22%, meaning that by mid-April, 1,000 employees would have left the business. Well, Metro Bank, which received a £925 million capital injection in October last year, was reporting a pre-tax profit of £30.5 million for 2023, compared with a loss of £70.7 million in 2022. Although at an underlying level, the bank was still loss-making. The shares rose by 1% this morning. They're currently off by half of 1%. Shares of Balfour Beatty, meanwhile, surged by more than 9% this morning after the Infrastructure and Construction Services Group raised its dividend and announced a new share buyback programme. Now, the company, which employs more than 30,000 people worldwide, including 12,000 in the UK, was reporting an underlying operating profit of £236 million for 2023, up 2% on 2022. Leo Quinn, the chief executive, said the company was confident of further growth this year, while longer term it saw attractive opportunities in the UK energy, transport and defence markets and in the United States. And De Beers said today it expects to see a gradual recovery in diamond sales this year, following a decline in sales during 2023. The world's biggest diamond producer said it enjoyed sales of $430 million in its second sales cycle this year, up from $374 million in the first cycle and $137 million in the final one of 2023, noting growth in consumer demand in India in particular. But De Beers warned that demand remained sluggish in China and said that in the United States, retailers have been slow to restock after Christmas. Now, you may not realise it, but your local branch of Tesco or Sainsbury's may not necessarily be owned by that company. It's just as likely to be owned by a business such as Supermarket Income REIT, which owns 55 stores across the land and lets them to the likes of Tesco, Sainsbury's, Waitrose, Morrisons, Asda, Marks and Spencer and Aldi. Today, it reported an operating profit of £45 million for the final 6 months of 2023. That was up 18% on the same period in 2022. Well, joining me now is Ben Green. He's principal at Atrato Group, which is the investment advisor to Supermarket Income REIT. Ben, good to see you this morning.
Good morning, Ed.
Rents were up 10% during the period. How much of that was down to acquisitions and how much of it was down to contractual rent increases?
Yeah, a little bit under 3% was due to contractual rent increases and the rest was from acquisitions. We sold a very large portfolio of Sainsbury's supermarkets early in 2023, and so we made some acquisitions to replace that income.
Indeed. I mean, you paid, I think, £36.4 million for those properties. What do you look for in acquisitions?
So what we're after is large sites, typically on the edge of town, which are surrounded by population and adjacent to arterial roads. And those sites are ideal for customers to come and shop in person, but they're also fantastic last-mile locations for online grocery. So they work perfectly for Tesco's and Sainsbury's to do home deliveries. Not a lot of people know that 80% of grocery home deliveries are actually made from a store, not from a warehouse. But then also, obviously, the customer's king. So, if the customer wants to come and click and collect, the supermarket can also offer that from those sites.
And typically, what proportion of the portfolio would be subject to a rent review each year?
That's a really good question. I think 68% of the portfolio is on annual rent reviews, and then some of them are on a 5-yearly cycle.
Annual, yeah. I mean, that's quite unusual.
Yeah, it's quite typical in the supermarket space because a lot of these transactions were originally sale and leasebacks, and they were kind of structured that way originally.
And typically, how much would a rent go up by when it is subject to review?
So most of our properties have inflation-linked uplifts, and that's either CPI or RPI, and those are typically capped at about 4%. So recently we've been seeing those contractual uplifts coming through at between sort of 3.5% and 4% because of the high inflation over the last couple of years.
So it's a nice, predictable income stream.
It's very predictable. It's highly contracted. And unlike a lot of real estate companies, Supermarket Income REIT has 100% occupancy because,
well,
there aren't any empty supermarkets.
The holy grail of the commercial property sector. Yeah, I mean, what are you hearing from your tenants right now? Are they fairly cheerful?
I think the performance has been very good with our key tenants. So 80% of our properties are let to Tesco's and Sainsbury's, and they've really been outperforming the market. That's been a combination of the fact that they've been able to use their scale to protect consumers from some of the inflation. Obviously, not all of it, but they've done very well at sheltering consumers. They've become very competitive with the discounters on price across the equivalent range, and of course they offer that online offering that a growing number of people want to be able to access from their grocer, and not all of them can offer that.
Yeah. Now, as you say, you did a big deal around this time last year with Sainsbury's, where they took back some properties from you. You used some of that money to pay down debt.
Yes, I mean, the story of last year was really taking a pretty conservative approach and cautious approach to leverage and risk, because the backdrop was really quite uncertain in rapidly increasing interest rates and very high inflation. I think the story for the next 12 months is much more confidence in terms of potentially using some of the balance sheet capacity we have now to make some more acquisitions and to grow earnings for Supermarket Income REIT.
Before I let you go, Ben, there's a fair bit of consolidation going on in the sector. Would you want to be an active participant in that?
I mean, we can all see what's going on in the REIT space. I think our investors really like the fact that we're a specialist in grocery. So if something happens, it'll happen. But I think for the time being, I think everyone's pretty pleased that we're just focusing on our knitting and
stick to. No one ever went bust sticking to the knitting.
No, exactly.
Good to see you this morning. Thank you.
Thank you very much.
Well, another solid session on Wall Street, during which the S&P 500 notched up its 17th record high of 2024, was followed by falls overnight for equities in the Asia-Pacific region by and large. Sentiment was dented by the Chinese property developer Country Garden, missing a coupon payment on its debt. Well, in Europe this morning, stocks have been largely trading to the upside. Here's the current picture in mainland Europe. That's on the back of a clutch of well-received trading statements. Talking points this morning include Inditex, the parent of Zara, which is up 5.5% in Madrid to an all-time high on better-than-expected sales figures. Well, here in London, the FTSE 100 is more or less unchanged right now. Mixed trade going on there, it's fair to say. The mining and commodity trading house Glencore is the leading blue-chip gainer this morning, up nearly 2.5% on support from one of the brokers, while Flutter Entertainment, the owner of Paddy Power and Betfair, that's up by 1.75% for similar reasons. Outside the FTSE 100, I mentioned them earlier on in the programme, Balfour Beatty still up nearly 9%. That's on its results. But the iron ore producer Ferrexpo, mentioned them a couple of days ago on the programme, shares there currently off some 5% after it postponed publication of its results. Meanwhile, Hochschild Mining is off nearly 4% on a trading update. On the foreign exchange markets, well, it's all pretty quiet thus far this morning. Sterling more or less unchanged against both the dollar and the euro. Single currency up around 1/7% or so against the greenback. The oil price, meanwhile, has continued to grind higher ahead of today's update on US crude inventories. A barrel of Brent crude will currently set you back $82.94 a barrel. That's up 1.75% on the session. Well, joining me this morning is Victoria Scholar, Head of Investment at Interactive Investor. Victoria, morning to you. I mean, the big corporate news story in mainland Europe today, no doubt about it, is Inditex.
Yeah, that's right. Very impressive results from Zara's parent company, managing to navigate those macroeconomic headwinds quite successfully. It achieved a 30% rise in net income for last year, sales up 10%, and it already seems to be doing pretty well in terms of its performance in this financial year. So between February and March, sales have already gained 11%, and it seems to be outshining its rival H&M. It's managed to position itself both in terms of quality and affordability, and it's not participating in that race to the bottom on price with the likes of Shein and some of the other online retailers, but it does manage to nimbly keep up with all the latest trends, appealing to the fashionistas, and that's partly thanks to strong relationships with suppliers. That means that it can respond to customer demands by increasing supplies of popular items.
Now, elsewhere in mainland Europe today, we've also heard from Adidas today. Not such an encouraging story.
No, so obviously the share price has done very well over the last year, but in terms of its financial performance, it reported a net loss in 2023 for the first time since the early 1990s. We saw that footwear sales have actually been doing very well. It's got some very popular ranges like the Sambas and the Gazelles, but the apparel range has been struggling with sales down sharply. And I think that's partly because of the boom in athleisure and all of those brands like Lululemon and Alo and others that makes it highly competitive to stand out in the clothing part of the market. It's also been dealing with the fallout from its tie-up with Kanye West and the suspension of its Yeezy trainers that was very popular for Adidas. So new CEO who's come in about a year ago, just over a year. Investors are pretty encouraged by what he's been doing, focusing on footwear, improving relationships with independent retailers as well. And that's why shares have done very well over the last year. But then it's just about translating that into a strong bottom line.
And closer to home, Victoria, briefly, if you would, please, Metro Bank, what do you think of the numbers there?
Well, we know that it's had a very, very tough time over the last year, reported a full year loss, but it was smaller than expected. The share price reaction was pretty positive at the open, but it has given back a lot of those gains. It's still struggling with deposit outflows and volatile trading, and it's really focusing on this cost-cutting plan now. I think it's trying to save about £30 million in the coming months, and it's planning to lay off about 1,000 jobs. So hard yards ahead for the Challenger Bank.
Indeed. Victoria, have to leave it there, I'm afraid. Good to see you this morning. Thank you. Still to come here on Business Live, I'll be speaking to James Sutherland, the co-founder of Autonomo, one of the fastest growing cashier-free checkout software companies. Stay with us.
Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles. We aim to be the best and the most trusted place for news.
I'm Martin Brunt and I'm Sky's crime correspondent. We take you to the heart of the stories that shape our world.
I'm Helen Ann Smith. I'm Sky's Asia correspondent and I'm based here in Beijing.
We help you understand the world with us. I'm Neville Lazarus and I'm Sky's reporter based in Delhi.
Emirates premium economy. Maybe one day all airlines will have seats like this.
Fly Emirates, fly better.
Welcome back. Now, cashierless stores such as Amazon Fresh are becoming an increasingly common sight around the world, with Aldi reportedly the latest major supermarket operator trying out the technology. Well, one of the fastest growing players in the field is Autonomo, whose checkout-free software enables retailers to convert existing stores into a cashierless shopping experience. Today, it completed a £2 million seed funding round with investors including the London-based Potter Ventures and Liverpool-based River Capital. Well, joining me now to talk about this is James Sutherland. He's co-founder and CEO of Autonomo. James, welcome to you. How does the system work?
So, grab a card, tap it to enter the store, put it in your pocket. We use a network of cameras to anonymously track the shopper through the store. When you pick up a product, we add it to the digital basket. When you put it back down on shelf, we take it out of the digital basket and then you just walk out. Shortly after leaving the store, we'll send you a receipt for the purchases.
And the card is linked to the customer's bank account?
The card is linked to the customer's bank account and we just extract the money that they've for the products that they've purchased while in store.
Now, you mentioned the word autonomously then. I mean, some people might have concerns about being tracked around a store on camera. I mean, people are anyway, aren't they?
Yeah, they are anyway, but also when we do our job well, the technology is invisible. And so we have, in terms of customers, you might think that it's dominated by younger, kind of tech savvy, but actually it's the opposite. It's younger tech savvy and very old. So we have a kind of a bell curve in terms of customers because it is not really about technology. It's about fruits and vegetables and shopping as you would normally shop. So once you've tapped in, that's it, done with the technology.
Does consumer behaviour change with this sort of environment? Because, I mean, a lot of people are carefully going around a store and looking at the price of everything. If they're just popping it into their basket, do they tend to spend more, perhaps?
Yeah, so we see people trading up, but we see people shopping more frequently. So because now a shop can take 8 seconds, so if you just want to go in, grab a Red Bull and get out to lectures or get it back out home, it's 8 seconds. And so we see the frequency of purchase going up and the basket spend also creeping up. So every week, basket spend goes up with the confidence that the shoppers have in the store by about 15 to 20 cents or 15 to 20p, depending on the market that we're in.
That's very interesting. And where are you seeing demand at its greatest?
So we work with petrol stations, we work with convenience stores, we work with supermarkets, we work with grab-and-go style stores, and it's anywhere where retailers are struggling to recruit and retain reliable staff. And that's pretty much anywhere across Northern Europe. So all of our customers today are in Germany, but we're branching out into Luxembourg, now into the UK, and into Scandinavia as well. But petrol stations, grab and go, convenience, supermarkets, stadiums even, is where the demand is. So at the moment, the customers are coming to us with a particular use case. And because our technology uses anonymous tracking of humans and recognizes products, our solution really works across all of those channels.
You make the point in the statement that this is potentially a way of combating shoplifting.
Yeah, exactly. So we've seen theft come down to almost zero. Why would you enter a store when there's cameras that you know are anonymously tracking you through the store and there's a gate to get in? It's easier. If you want to steal, you still could theoretically, and there are ways, but there's just easier ways to do that in a regular supermarket. And so theft comes down to a near zero in our experience.
Okay, and what are you going to do with the capital you've raised this morning?
So it goes into building better technology. We're recruiting here in the north, here in the UK, but predominantly in the north of the UK. So Manchester, Edinburgh, Leeds, Sheffield. We're recruiting in computer vision. The core skill set of our business, we're about 30 people, and the core skill set is software engineers and computer vision engineers. And so we'll be building a team here in the UK, as well as expanding into different retailers here also.
OK, James, got to leave it there. Best of luck, and good to see you this morning. Thank you.
Thank you.
That's it from me for the time being. I'll be back, of course, at 4:30 with our afternoon edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Prime Minister's Questions. See you later on. Thanks for joining me this morning. Cheerio.